This presentation introduces Vizsla Silver as a high-grade silver developer with meaningful upside and real execution risk. The company's story now rests on three pillars: investment appeal, economic strength, and the path from exploration success to funded development. At the center is the 100% owned Panuco project in Sinaloa, Mexico. Vizsla is no longer just an exploration story. It is increasingly being evaluated on feasibility economics, funding strength, permitting progress, and execution. The key investor question is whether Panuco can become a major new silver mine while preserving the strong economics outlined in the study. Vizsla Silver is one of the more closely watched silver developers because it has moved beyond discovery and into the funded development stage. The company is centered entirely on the Panuco silver-gold project, which it owns outright. The big milestone here is the target for first production in H2 2027. That timing matters because the market is now valuing Vizsla less as an explorer and more as a future producer. From this point forward, value creation depends increasingly on engineering, permitting, construction readiness, and the ability to execute the development plan without major setbacks. This slide highlights why Vizsla stands out. First, Panuco is a high-grade district-scale asset. Second, the feasibility study is exceptionally strong, with $1.802 billion after-tax NPV, 111% IRR, $173 million initial capex, and 7-month payback. Third, the company's funding position is much stronger than many peers, with over $450 million in cash as of January 2026. Fourth, exploration upside remains meaningful, with more drilling and new discoveries still possible. Finally, the silver market backdrop is favorable, with 2026 expected to be the 6th consecutive year of structural deficit. Panuco is the core of the Vizsla story. This is a single-asset developer, so nearly all company value comes from one district in southern Sinaloa near Mazatlan. What supports that concentration is the district's geological scale. Vizsla now controls a highly prospective land package, with over 86 kilometers of vein strike and around 35 kilometers of historic underground workings. That gives the company both a defined development asset and long-term exploration runway. Investors should think of Panuco not as one isolated deposit, but as a broader silver-gold district with multiple potential value drivers over time. This slide reinforces that Panuco is more than a single deposit. It is a district-scale silver-gold system with multiple high-grade veins and multiple resource centers. That matters because district-scale assets often create more long-term value than single-deposit projects. Exploration can extend mine life, add new production centers, and improve future throughput options. For Vizsla, the broader opportunity is that the current mine plan may represent only the first phase of a larger story. Continued drilling success could allow the company to grow beyond the initial feasibility study and increase long-term strategic value. The January 2025 resource update was a major milestone. Measured and indicated resources increased 43% to 222.4 million ounces silver equivalent, and grade improved by roughly 5%. Just as important, Vizsla established its first measured resource, 46 million ounces AGEQ grading 640 grams/T AGEQ. These are higher confidence ounces, which support better mine planning and stronger financing credibility. For the market, this update improved both scale and quality at the same time. That is a powerful combination for a development-stage silver company and one of the reasons Vizsla's valuation strengthened. The feasibility study is the economic foundation of the Vizsla investment case. The project shows an after-tax NPV 5% of $1.802 billion, an after-tax IRR of 111%, and initial capital of $173 million. The payback period is just 7 months, and the mine life is 9.4 years. These are very strong metrics for a silver developer. They tell investors that Panuco is not only economic, but economically robust. A high return, low payback, and manageable capex profile are exactly the kind of features that can support a premium valuation if the company executes successfully. This slide focuses on production and operating profile. Average annual production is expected to be 17.4 million ounces AGEQ, with 20.1 million ounces AGEQ during the first 5 years. That strong early production profile supports fast cash generation. All-in sustaining costs are projected at $10 and 61 cents per ounce AGEQ, placing the project in the lower quartile of the cost curve. Throughput begins at 3,300 tons per day and is expected to expand to 4,000 tons per day in year 4. High grades, low costs, and strong early output are what make Panuco especially attractive. Funding is now one of Vizsla's biggest strengths. In 2025, The company completed a $100 million United States dollars equity financing and a $300 million United States dollars convertible note offering. It also secured a Macquarie project finance mandate for up to $220 million United States dollars. As of January 2026, Vizsla said it had more than $450 million United States dollars in cash and considered the project fully financed. That is a major shift in risk profile. Many developers struggle because financing is uncertain. Vizsla has largely removed that problem, so investors are now focusing much more on execution and permitting than on capital availability. This slide shows that Vizsla is already a meaningful market cap company. It had 343.9 million basic shares outstanding and 367.06 million fully diluted shares, with a market capitalization of roughly $1.40 billion United States dollars as of March 11, 2026. That means the market is already assigning substantial value to Panuco. From here, upside depends less on discovery excitement and more on delivery. Investors should understand that Vizsla is no longer priced like an early-stage junior. It is increasingly priced like a serious developer, which means milestones such as permits, construction readiness, and resource growth matter even more. Vizsla's value is highly leveraged to silver prices, so the broader market backdrop matters. The feasibility study uses a silver price assumption of 35 United States dollars and 50 cents per ounce. The more important macro point is that 2026 is expected to be the sixth consecutive year of structural silver deficit, with the shortfall projected around 67 million ounces. That provides a supportive long-term backdrop for new primary silver supply. For Vizsla, a tight silver market improves sentiment and can strengthen valuation. If silver remains strong, Panuco becomes even more attractive as a future low-cost, high-grade producer. This slide summarizes Vizsla's best qualities. The company has a high-grade core asset, outstanding feasibility study economics, and a fully financed development plan. It also retains strong district-scale exploration upside, with discoveries like Animas showing that the project can still grow. In addition, the early production profile is particularly attractive, with 20.1 million ounces AGEQ per year in the first 5 years. This combination is rare in the silver sector. Vizsla is not just a financing story or just an exploration story. It combines project quality, economics, funding, and growth potential in a way that keeps investor interest high. The 2026 roadmap is all about de-risking. Management is focused on detailed engineering, contractor selection, test mining, bulk sampling, underground drilling, and permit progress. The target is a construction decision in H2 2026, followed by first silver in H2 2027. This is a critical period because the story is shifting from study results to execution. Every milestone completed in 2026 should improve confidence that Panuco can actually be built on schedule. Investors should think of this year as the bridge between strong paper economics and a real producing asset. This slide keeps the story grounded in risk. Vizsla remains a single-asset company, so Panuco drives almost all of its value. Mexico adds permitting and jurisdictional complexity, and security concerns in Sinaloa have become more visible in 2025 and 2026. On top of that, development stage execution risk is always significant. Construction, commissioning, and ramp-up can all create delays or cost overruns. Finally, project value is highly sensitive to silver prices. So while Vizsla has strong upside, this is not a low-risk investment. Investors need to balance excellent economics against very real operational and jurisdictional uncertainties. The bull case is that Panuco advances smoothly, exploration continues to grow resources, and silver prices remain strong. In that scenario, Vizsla could be re-rated closer to project NPV. The bear case is that security, permitting, inflation, or weaker metals prices reduce confidence in valuation. This slide is important because it shows how wide the outcome range still is. Vizsla has very strong economics, but the stock is still exposed to execution and macro risk. That makes it a high-reward opportunity, but one that can also remain volatile as the company moves toward construction. The final investment view is constructive but balanced. Vizsla has a high-grade asset, exceptional study economics, over 450 million United States dollars in cash, and a silver market backdrop that remains supportive. Those are major strengths. At the same time, the company faces real development, jurisdiction, and security risks. So this is best viewed as a high-upside silver developer for investors who can tolerate execution risk. If management delivers on permits, engineering, and construction timing, Vizsla could become one of the more important new primary silver producers in the market.